Hello dear viewers and students. Welcome to another lesson in accounting. In today's lesson, we are going to look at valuation of inventory part 1. What is inventory and why should we be careful about its valuation? Let us try to see the few scenarios that are coming. Hey Mr. Sam, where is my order? I've been waiting since long. I don't have any goods. I'm sorry, Mr. Tom. According to you, why do you think Sam could not supply the goods ordered by Mr. Tom? The reason is there was no inventory available. But in real business situation, do you think situation like this should exist? To be able to answer all these questions, first, let us try to see what is meant by an inventory. What is an inventory? The term inventory designates both goods held for resale to customers in the ordinary course of business activity and also to those that are included in various stages of production. Also, thus, we can say that inventory items are those which are purchased and sold regularly in a trading concern or purchased, put into production, converted into a finished product and sold in a manufacturing business. The type of inventories that businesses come across or deal with are such that inventories of a trading concern consist mostly of those items which are purchased for resale in their existing form, and those of a manufacturing concern consist of raw materials, work in progress, finished goods. Let us take a simple example. A trading concern like a shop selling shirts. At the end of the year, the shirts that will be left will be termed as inventories. That will be closing inventory or inventory of a trading concern. But on the other hand, let us take the example of the factory manufacturing the shirt. There, the shirt would have been manufactured from cloth and other raw materials. There would be shirts that where production is not yet complete, and there would be shirts which are completed but not yet sold. Hence, for a manufacturing concern, you're going to have the three types of inventories: raw material, work in progress, and finished goods. Therefore, items not used at the end of a financial period or items not sold at the end of a financial period is termed as closing inventory, which becomes the opening inventory in the next accounting or financial period. In other words, if we say we've got items at the end of the year 2018, at 31st December 2018, that will become the closing inventory. But on 1st January 2019, that will become the opening inventory with the same amount. That leads us to the definition of closing and opening inventory. Any item of inventory remaining unsold or unused in production at end of a certain period is known as closing inventory, which becomes the opening inventory at the start of the following period. Just what I said earlier. Let us look at an income statement extract where we look at the calculation of gross profit, where we'll be using both the inventory at start and the inventory at end. Here we can see that revenue is $10,000 less inventory at start, add purchases, less inventory at end, which gives the cost of sale of $4,000 and the gross profit of $6,000. What will happen if the inventory at start or the inventory at end are correctly or incorrectly valued? Let us take the first situation. Opening inventory overstated by $1,000. So the revenue would be the same as $10,000. Opening inventory, which was $3,000, would become $4,000. Purchases remaining the same, hence the total will be $9,000. Closing inventory the same. Cost of sale would become $5,000 with a gross profit of $5,000. That is $10,000 revenue minus cost of sale of $5,000. That gives $5,000 gross profit. As a conclusion, what we can say is when opening inventory increases, profit decreases. Let us look at a second situation. This time we say that opening inventory is understated by $1,000. The revenue would be the same. Inventory at start from $3,000 would become $2,000. Purchases remaining the same. That gives a total of $7,000. Closing inventory remain the same. Hence, the cost of sale become $3,000, which we deduct from revenue. That gives a gross profit of $7,000. As a conclusion, what we can say, when opening inventory decreases, profit increases. So far, what we've seen, there is a kind of inverse relationship between the opening inventory and the profit. Let us take a third situation. Closing inventory overstated by $2,000. Revenue would be the same. Opening inventory this time remain the same. Purchases $5,000, giving a total of $8,000. Closing inventory, which was $4,000, now overstated by $2,000, would become $6,000. The cost of sale $2,000, which is deducted from revenue $10,000, gives a gross profit of $8,000. As a conclusion, what we can say is when closing inventory increases, profit increases. Let us take a fourth situation. This time, closing inventory is understated by $2,000. Revenue remain the same. Inventory at start remain the same. Purchases remaining the same, giving a total of $8,000. Closing inventory, which was $4,000, is understated by $2,000, which becomes $2,000. The cost of sale becomes $6,000, which is deducted from revenue, hence a gross profit of $4,000. So what could be the conclusion here? Any guesses? When closing inventory decreases, profit decreases. Let us try to see a general overview of these relationships. So opening inventory overstated, profit understated. That is, when opening inventory increases, profit decreases. When opening inventory is understated, profit would be overstated. Hence, you can clearly see there is an inverse kind of relationship. When closing inventory is overstated, profit will be overstated. When closing inventory is understated, profit will be understated. Hence, we can see a direct relationship between closing inventory and profit. So what we can say, as seen, an incorrect inventory valuation affects profit. And when profit is overstated, it contravenes the prudence concept, which you will learn in the chapter of accounting concepts later on. Let us try to see what happens when closing inventory is overvalued. Let us try to see the effect in the current period. We've seen earlier, when closing inventory is overvalued, cost of sale would be understated, that is, decreases. Gross profit is overstated, that is, increases. Profit for the year will be overstated, that is, increases. In the statement of financial position, the closing owner's equity would be overstated. The current assets total would be overstated. The working capital, also known as the net current asset, would be overstated. We also mentioned earlier that closing inventory becomes, for the following period, opening inventory. So if your closing inventory was overvalued, implies that the opening inventory also is overvalued. Therefore, the effect on the income statement would be the cost of sale would be overstated, the gross profit would be understated, and the profit for the year would be understated. And in the statement of financial position, there would be no effect on the closing owner's equity. If you see the sequences well, you will understand that a wrong valuation of inventory has repercussions both on the income statement and the financial position in the current period, and as well as in the income statement for the next accounting period, that when the closing inventory is wrongly valued. Let us take another scenario. Closing inventory undervalued. The effect on the current period income statement. The cost of sale is overstated. The gross profit is understated. The profit is understated. Remember, we said there was a direct relationship between closing inventory and profit. Since closing inventory is undervalued, gross profit and profit for the year also will be understated or undervalued. In accounting, the terms undervalued, understated can be used synonymously for each other. The effect on the statement of financial position in the current period would be the closing owner's equity will be understated, and the current asset will be understated. The working capital or the net current asset would be understated as well. What would happen in the next accounting period? The closing inventory, which is undervalued in the current period, will become opening inventory undervalued in the following period, and the effect on the income statement would be cost of sales understated, gross profit overstated, profit for the year overstated. Once again, if you will recall, we said there would kind of inverse relationship between opening inventory and profit. So you can see opening inventory undervalued, which leads to gross profit and profit for the year being overstated. The effect on the statement of financial position would be closing owner's equity not affected. Hence, the effect of incorrect valuation of inventory would be the effect on the accounts, the effect on the profit, the effect on working capital net current asset, and the effect on the statement of financial position. Let us look at the effect on the financial statement. We've seen that in the income statement, the trading account section would be affected through the calculation of cost of sales, and in the statement of financial position, the current asset would be affected because of a wrong valuation of closing inventory. Also, an incorrect valuation of closing inventory will definitely affect the financial statement, which implies that closing inventory becomes opening inventory of the next period, and effect on closing inventory will be seen on opening inventory in the next period, thus affecting cost of sales. And as a result, incorrect valuation of closing inventory will affect figures in financial statement over 2 consecutive years. Therefore, we need to be careful while valuing inventory because it will affect both the income statement and the statement of financial position. Let us look at the effect on profit. An overvaluation of closing inventory leads to an overvaluation of profit, and undervaluation of a closing inventory leads to an understated profit figure, thus a direct relationship. And the contrary is true for opening inventory, as we've already discussed earlier. The effect on working capital or net current asset. Since closing inventory item is recorded under current assets in the statement of financial position, which is used in the calculation of working capital and solvency and liquidity, hence, a wrong valuation of closing inventory will wrongly affect the current assets as well as in the calculation of working capital or net current assets. You can see that if when closing inventory is overstated, current asset overstated, working capital overstated, and the contrary is true when closing inventory is understated. Now, effect on the statement of financial position. Since valuation of inventory affect profit and profit is included in owner's equity, incorrect valuation of inventory will affect the owner's equity, thus affecting the final statement of financial position, the combined effect on the current assets, leading to net current asset and net assets. So we've seen why should inventory be correctly valued. Otherwise, there would be a wrong valuation in the profit figure as well as wrong valuation of figures in the statement of financial position. We've reached to the end of the first part of inventory valuation. I hope that you've understood the concept and you've enjoyed the lesson well. Wait for you for the second part of inventory valuation. Until then, thank you for your attention.